Welcome back to another episode of Fun Friday with a very special guest, a seasoned commercial real estate veteran, still going strong. Please welcome to the show, Senior Vice President at PeakHill Capital, Scott Croul. How are you today?
Very well, Craig. Thanks for having me. I
Yeah.
appreciate it.
Yeah, well, we got the pleasure to actually connect just a couple weeks ago. Turns out that there wasn't a direct fit today, but there was a fit for you to, of course, drop your expertise and knowledge on us here as you've worked out many things with your very robust background. But before we get into all that good stuff, let's learn a bit about your background and what you've done professionally to get you are to where you are today with Peak Hill.
Sure, absolutely. You just tell me where you want me to start.
Well, as we were speaking, pre going on air, just going through your very long and incredible and diverse resume. Let's just start with your CBRE experience in the '90s. What you were kind of going through there in the commercial world, the changes that happened then, and then maybe we can go to working with Freddie Mac and the loan workouts to what you're doing today with Peak Hill.
Okay, perfect. Well, yeah, I got in the business, and in the early '90s, we went through another crisis that had major impacts on the market. And I was over at CBRE to work on distressed assets. So basically, their watch list portfolio for a correspondent lender, Aetna. It was about $6 billion portfolio, and I was responsible for the assets and the loans that were in the Southwest region, mostly in Southern California. That was a diverse mix of properties ranging from trophy assets on the on the apartment side to industrial, self-storage, hospitality, pretty much the gambit. The market was in trouble then, and there were a lot of impaired assets, and so we were doing quarterly reviews on various assets that had high risk, looking at rollover risk, retention risk, and sublease and all that sort of stuff, using discounted cash flows that were done through a program that's no longer around, Project Plus. It was the precedent to what I think is widely used now, Argus. And so we did cash flow analysis to determine the risk levels, and then as necessary, restructure loans to minimize impairment and help sponsors hopefully right the ship, allow us to get to a point of stabilization. And we're seeing that right now. So there's comes full circle, like it
As it
does
always does, right?
every decade or so. We get back to the beginning again and start over again. So it's just the same story with different players and different technology. We certainly have a lot more now with the internet than we did back then. It was all pretty much paper and pencil. It seemed like back then.
Yeah, well, I actually have a couple follow-up questions there from your experience with working that out, which is for those who don't know, what is the watch list? Could you explain that in simple terms?
Yeah, so the a lender will go through and look at their loans and look at ones that they fear have a likelihood of default, or they will do a risk assessment of them. And the ones that are highly rated as far as risk goes would be on the watch list, in which case they're keeping a closer eye on those. So they're doing, reviews on those on a quarterly, semi-annual, or annual basis to just track and see how they're going. So they might be looking at an office building with a lot of lease rollover in the next 12 months, and it's if those tenants don't renew, then it's going to create severe risk and potential impairment to the loan in place. And so the lenders are always going to be monitoring the leasing status, activity levels, and all that sort of stuff to see what's going on. There could be a lease in place that the tenant's already vacated and they're trying to sublease the space. So really digging into kind of what's going on underneath the surface to ascertain the actual risk in place, so that when those leases roll over, you're prepared and you've got risk mitigants in place, whether that's you've set up reserves so that you're able to fund, leasing commissions, TIs, downtime, all that sort of stuff, and hopefully get to a point to where the property has um, rebalanced itself or at least restabilized itself on the occupancy side in a way that hopefully also supports the debt.
Right. So how would you say technology from, that role has changed the game? And I guess more of your experience because starting in the 90s, as you mentioned, computers might have been, used, not used, but now you analyze data from graphs, charts, Excel, things of that nature. Before it was a little bit more primitive and archaic. So can you just go through a little bit of the nuances that have kind of shifted there?
Yeah, I mean, certainly, I had a deal, it was a 1 million square foot deal in Orange County. There's probably 1,000 tenants, and the Project Plus model couldn't take that many tenants in. And it was always, when you've got a project that big, leases are rolling over every day. It's like an apartment property. So trying to do lease analysis and put static leases, it just was impossible because there just wasn't the capacity in the model to do it. Plus, it was a fluid situation. Now you've got technology that does a lot of that stuff instead of having to manually input those things. You've got rent rolls that are on Excel spreadsheets that you can input, import, and even you can change now or convert PDF files to Excel format so
Yeah,
you can
life's a lot easier now, right?
life's a lot easier. And then back then, you didn't have the same level of market intel that you have today. So a lot of it was gathered by phone calls, talking to brokers and appraisers and all that stuff, really getting deep in the weeds on a man-to-man basis, more so than just being able to dig into the internet and use CoStar or any of those goods. You didn't have CoStar in a format that would be accessible like it is today.
Right, that makes sense. And I guess when did CoStar and Yardi and those services really become uh, crucial and big in the day to day?
It's hard to say. I would think it's probably going in probably post. So we had Y2K. Everybody was afraid about Y2K. So I think it's probably post Y2K.
Right. Okay. So basically, thousands internet companies take off. The economy got more wrinkled and more robust from that point forward, which makes sense. But going back to kind of the CBRE days, your 90s experience there, when a deal got on the watch list and stuff, would you say it's usually from just the DSCR constraint? How did the deal end up there? Was it basically just bad fundamentals, mismanagement? What was the reasoning as to why deals got there? And from just a historical perspective, when you're doing that, another question there is how many deals that got on watch list got off and ended up scot-free, if you will.
Yeah. So usually it's not bad management. It really is market pressures. And so the properties were identified based on the markets they're in and the types of properties they are. Then you look at the rent rolls and see where the lease rollovers are. If you've got a large tenant that's in 25% of the property or greater, you're going to be focused on whether they're going to renew or not. You're going to focus on whether they're actually using that space or not. How much space are they using? Are they trying to sublease that space? And really dig in there. So you're focused on the market and the asset as it fits in the market. Then you drill into the actual tenancy in place, and then you can make your decisions on risk. Certainly there's other things that could come in play. I mean, we had a property that had, they were down in San Diego. Access was across a bridge. The bridge washed out in a rainstorm, and so you didn't have access. So that one got on the watch list, all weather related.
Yeah, not really sponsor level or deal level, but circumstance level. Is that
Yeah,
correct?
exactly right. And so uh, it really wasn't more of a unique situation for each one, but the same earmarks for all of them, and that is what the market looks like, and then we look at that role and how that's elevated vacancy. Obviously, that's one. But even if you drilling in to see where the lease roll is, when it is, and whether the tenants are actually occupying their space.
Right. Makes sense. So you're there, then you go to working with Freddie Mac, and that was around the GFC and kind of after that, which was a lot of loan workouts. So can you kind of touch on your experience there as well, and maybe how informative that was to what you're doing today and just kind of what you were seeing around that time, which is obviously really crazy?
Yeah, so post GFC, Freddie Mac went into conservatorship, and we're all trying to figure out how things are going to turn around. I got there in 2010, right? And so we still had a couple years left before I think things really started to feel like we're moving in the right direction. And there were a lot of properties that were in trouble. And so we did see a number of properties that ended up um, performing poorly and that we had to take back. We had
Diplomatic. Very diplomatic of you right there.
right,
Yeah.
right. And we had a special servicing team that mostly handled that. However, as the guy that was running the region here in the West, they used me for market expertise and look at the properties and really get some more ground level intel on the properties while they're working directly with the sponsor themselves. So my interactions were really more with the special asset management team than it was with the sponsors. However, I became exposed to all kinds of problems that happened, and a lot of it was in markets. A lot of stuff that were in markets that were just performing poorly, just not really strong markets, or markets that just were heavily impacted. We had downtown Los Angeles back then, was really experienced some severe problems. A lot of office tenants had vacated the market there, and that led to elevated vacancy in the multifamily properties as well. And so we were looking at new deals there, and we were seeing properties that were at high vacancy levels that we would underwrite by adding another 10% vacancy, maybe on top of that. It was belt and suspenders all day long, but it was the only capital around. And so we were able to write loans that were, very good loans as a result, because we ended up doing deals at what was really the bottom of the market. It was really hard to tell whether it was the bottom of the market, but we were able to approach it with a framework that made it so that we were protected from, at least any foreseeable downside risk. I mean, we could have gotten much worse, but we felt that we made prudent choices in our underwriting to insulate us from any downside risk.
Right. So when did you start working with Freddie Mac then, I guess, just to back up there?
Yeah, so I started there in May of 2010.
Wow. So basically, at that point, most of the dust had, I guess, theoretically had settled. There was certainty, or at least, I mean, you never know really at the moment, but the stock market had dropped. Obviously, the adjustable rate mortgages and foreclosures were spiking, jobs were lost. So you probably hadn't gone through enough cycles of the 90s and, the 01.com boom, had seen probably enough of the tall tale signs that, hey, this is probably close to the bottom. Would you say it's a fair assumption?
Yeah, I mean, it was market by market. So there were markets like Phoenix where there was definitely still a ways to go.
Phoenix didn't come back actually, because I used to sell homes here. So you'd see the tracker on when a house was sold. You'll see it sold in 2017, or sorry, 2007. Then you'll see it sold in 2012, and it was for literally less than half the price. And
Yes.
then you saw some places similarly that were sold in '07, and then they sold in 2018 for maybe the same price. But if you bought Los Angeles real estate or Bay Area real estate or New York real estate at that point, for that matter, you probably would have experienced at least a double from where you bought.
Yeah, absolutely. And I think the same thing's happening now. I mean, certainly, um, it does seem like Southern California is very well insulated
Well,
from,
Phoenix is as well. I mean, Phoenix has
yeah,
got Arizona's got a way bigger influx of people moving here than California. 'Cause California technically is a net loss, but I don't think that's really pertaining to the OC or Los Angeles or Bay Area areas specifically.
yeah, absolutely right. I mean, certainly the Phoenix market went from really a place where there's a lot of back offices, call centers. Yeah, they started to have some fab plants there for chips and wafers and all that sort of stuff. But that was really preliminary. Now it's a highly diverse market,
Well, the
and
Phoenix used to be a boutique market, if you will, and it was kind of a
yeah,
call center hub. And now you've actually got legitimate corporations who are choosing to move here and other businesses and such. And of course, manufacturing jobs, chips and whatnot. TSMC's, ambitious $40 billion plant isn't, a nominal feat whatsoever. When you speak to the jobs, a net new job. It's not factory A shutting down, but factory B next door opens up, where there's not net new jobs. It's basically a lateral switch. These are horizontal moves.
yeah, yeah, exactly. So back in 2010, I don't know when the phrase stopped being used, but there was a don't catch the falling knife, and certainly the Phoenix area was one of those areas where there was that level of concern. And it took a while before, like you said, it started to rebound.
Yeah.
But the people that got in, even if it wasn't the bottom, they rode a nice wave up.
Without a doubt. So you get into the debt side of things, and were you originating loans? So for Freddie, just so we're all clear, so you were writing the loans, were you approving the loans? I guess talk about that more specifically in the weeds, if you will.
Yeah, yeah. So when I first got there, I was running the underwriting and credit team. So I managed a team of underwriters, and then I had approval authority. The way they set it up was the approval authority. It was meant so that we could approve 80% of the loans in the region. They're just if we had it any other way, it just overwhelmed the home office. And so we were doing I think that first year it was $3.2 billion, and then it just grew exponentially from there. The Most of the business we saw initially was in Southern California, and then it just started growing from there. And as we grew, we expanded our offices. So we only had one office in Los Angeles, and then we opened an office in Orange County where I'm at, and then that was followed by Denver and Seattle over the course of like a 10-year period.
So were you regional then? So those are the places that you were mostly doing the loans for, or were you all, nationwide with your loan processing and such, and what your role was?
Yeah, so my role covered the Western region, which is defined as at least at that point in time, as the Rockies West, including Alaska and Hawaii.
Would that include Texas then?
No, Texas was being covered out of our Chicago office at that
That
point.
makes sense. Like kind of the Southwest or basically Midwest region, if you will,
Yeah,
down.
exactly right.
Okay, very cool. So let's talk about what a loan workout means, because I think that's a flavor of the day, for the obvious reasons. And I think just talking about, recessions and whatnot and kind of history doesn't repeat itself, but it rhymes. Let me explain. Naturally, during the '08 recession, '09, we had the mortgage collapse, which was because the variable adjustable rate mortgages went up. When rates went up, your other costs went up. People can make the payments, they got laid off, and the house of cards collapsed. Similarly, of course, on the commercial world, a predominant swath of the loans done were variable rate or bridge, which are either inherently shorter termed with maturities coming up right now or already matured, or floating rate debts where if you don't have a rate cap or everything else going on, your escrows are really expensive and you basically can't cash flow anymore and you can't get out of the deal because there's an equity evaporation, or God forbid it's trading below paper. And what trading below paper means is that the loan is here, but let's say it's $20 million loan amount now, or what was taken out, but now the property is valued at 18. That means you owe the bank $18 million or the $2 million spread there, and your equity's evaporated. So that's going in real time. So can you explain to people what a loan workout is and the process of it and all the details between? Because I do think it's a very topical conversation right now.
Yeah, well, it certainly is. There's a lot of impairment there across all asset
That's a
classes.
good way of explaining it. Impairment.
Impairment, that means that the loan is worth it. The face amount on the loan is worth more than the property. So you're upside down, the loan is impaired, you're at risk of not recovering your loan amount, let alone your interest. And so, generally speaking, you will have a sponsor that's trying to get some relief, and if there's a desire on the lender's part to come up with a resolution rather than just take back the property, you go into a loan workout, and that would generally entail a restructuring of the loan so that in a lot of cases you might split it up so that there's an A note portion that is rebalanced down so that it's really property leverage based on the new value of the property, the current value of the property, and then a B note, which is generally speaking more of a promotion structure or a hope note, where you're going to have some accrued interest. So you're not forgiving that amount, but you're
Extending.
deferring it.
Yeah.
You're deferring it so that they'll pay you off at exit.
Extend and pretend, as some people call it,
Extend
right?
and pretend.
Yeah.
Exactly right. So, the problem with those workouts is you want to have a sponsor motivated. So if you wipe them out, it's like, what's the point?
Yeah, I'm not going to focus anything here, but if you give them a little nugget of an upside, you're kind of saying, hey, you're probably not going to make what you thought you were, but you're not going to lose everything, and maybe, just maybe, you can squeeze it out okay, right? Is that kind of the promise or the
That's
the, the
it. So I
premise?
mean, and certainly, you might negotiate what the upside looks like. And so maybe you try to, if you're a sponsor, like, oh no, it's not going to be that good. Because you want to build yourself a bigger promote. And so hopefully you can come to target returns that make it so that there's motivation on both parts. And then the lender wants that too. They want a sponsor that's engaged, that's motivated, that's going to make it happen. So there's this push and pull between the two to try to come up with a structure that works for everybody and makes it so that you're not getting into too deep of distress. Now, a lot of these loans are syndicated, or excuse me, are securitized, and that limits the ability to do that because now you've got third parties essentially that are involved. So what we've seen are a lot of these CLO lenders will buy them out of the pools, and then they're able to have that flexibility. Now they're portfolio loans to where they can have the flexibility as it relates to a restructure to hopefully create a desirable exit for all parties. I mean, certainly they're most interested in their own exit and their own returns. The beauty of properties going into default, you get default interest. So there's, if you can recover the loan plus default interest, it's really kind of a bonus situation.
Right. That makes sense. So it's kind of funny, and you might laugh at this. It's not funny if you're in the situation, but it's a funny premise. And I credit this one to Jack Krupe. I don't know if you've had the pleasure of meeting him before, but great guy, has a bunch of Wall Street background. And he says this: if you owe the bank $1 million, you're effed. If you owe the bank $1 billion, they're effed. So, can you kind of speak to kind of that premise right there? Because, the bigger you are, obviously, the more, paper, the more, it's important for that bank to basically work something out with an individual. So did you ever see experiences like that during your loan mod and, workout days where it was like, wow, this group is just too big to fail, and you just frankly, due to the volume of loans and the figure number that it is there, that you need to figure out a solution there or workout?
The default rates at the agencies are extremely low. So we never really experienced that. That's not to say it didn't happen. I mean, certainly the banks are that way. And then you have sponsor concentration risk. A lot of the big players these days in multifamily are more agency focused, but those that weren't, a lot of the newer groups that, were really heavily reliant on the value add program might have a concentration with one lender, but a lot of them have a fairly diverse. All the lenders were competing with each other, so you might not have that big of an influence on any one lender because your loans are diversified across maybe a dozen different CLO lenders out there. So, I'm sure there are situations where there's some serious concentration. I could think of one or two where, yeah, there is that risk, and the lender is trying to figure out a way to solve that problem, probably in a way that's a little bit more favorable to the sponsor than it would be if they only had one loan with that lender.
Right, that makes sense. Okay. And how would you say all of your kind of experience and acumen from, your very long and, unique career with saying several cycles has kind of led you to be in a perfect position with PeakHill Capital? Because if I'm not mistaken, you're doing pref, you're doing recaps, and what else are you doing at PeakHill Capital?
So it's mostly prep, and it will be, it's either recaps or cash neutral refis or acquisition financing.
Okay.
What we saw going into this summer, it seemed like, was a lot of people trying to figure out a solution to their floating rate loans. And it was driven generally by rate caps, but as well as just the high cost relative to fixed rate loans. So they're trying to get out of their floating rate debt into a fixed rate on a cash neutral basis and using preferred equity as a way to balance it out. The problem is a lot of these loans, by today's standards, are upside down. And so it's pretty hard to get voluntary equity involved in those situations. And then if they are just trying to do an extend and pretend with their current bridge lender, those extensions are generally 1 year, and that's just not a long enough period for preferred equity to get comfortable. We're generally looking for, say, a 30-month minimum investment period and a multiple based on that for them. So that just makes it so that a 1 year extension is not going to get us there. There's no saying if maybe this lender might have agreed to overlook certain covenants on the loan this time around, whether they would do that again next year. And so, a lot of those loans are really kind of stuck in a position where they're going to have to come in with more equity on their own, and either to extend it or to just replace that financing, we're looking at handing back the keys.
Right. What are the costs of doing business with a group like yourselves? I mean, to a certain extent, it's a commodity, right? But I'd be curious to know what your pref rates are, your recap rates, all kind of and I imagine some of it is a little bit of a not a one size fits all kind of program and solution, depending on what you're doing, probably outside of pref would be my guess. And then also, what is the pref that you offer? Is it, hard, participating, so on and so forth? Be curious to get into the weeds and nuances of that.
Yeah, well, let me just finish up on what we're seeing in the market, and that is we've
Yeah.
gone from that situation where deals just didn't make sense because they were upside down to whereas now we're starting to see some positive trends. We're seeing acquisition activity pick up where the cap rates are at a point where you can underwrite them in a way that would allow for pref. And so I'm very encouraged by the current trends that we're seeing. As far as what we're looking at in terms of yields and requirements, it's risk-based lending, and so the preferred return that we're looking for is a measure of that. So I'd say our target range is returns of 14 to 16%, generally averaging in that 14.5 to 15 range for the most part, but higher risk situations, we will go higher. As far as the structure, we're not looking for a promote structure. It is just a straight preferred return. We want a current pay, generally targeting, saying that's 8% range plus or minus. The rest would be accruing and on a compounding annual basis over the term of our investment. And we're really seeing most of the deals right now probably fall in that close 14.5% range.
Makes sense. And then what is the fees for the other businesses or so the other products that you have, like the recaps and other notes that you do if you do them?
Yeah, so really it's just preferred equity, but it's preferred equity utilized for various things. So we've done preferred equity on recapitalizations. we did one on a 10-year Freddie Mac loan. We generally want to be out after 5 years. And the premise was they're going to do a value add and be able to get a supplemental and pay us off sometime within that initial 5-year period. And so we were able to get comfortable with that longer term. We have to be at least coterminous with the senior loan. And we did a 10-year preferred equity investment with the intention of getting paid out over 5 years.
Makes sense. So with what you're seeing right now, what are some of the signs that are kind of making you concerned? Because you've seen this movie before. We're obviously in a real-time switch right now. So be curious to hear your insights into the market and kind of what you're looking for from, an investment perspective and kind of what, you think is going to come, pull out your crystal ball if you can, please.
Yeah, I mean, it's tough. There's a lot of conflicting information out there. Certainly, it seems like we are avoiding a recession, or maybe we had a soft landing, you could call it. So that's good news. But at the same time, we're seeing massive deliveries in most of the major markets. And these are high growth markets. So the long term is good. Especially now with rates going up, it's not like there's a lot of new inventory coming to market. So we're seeing elevated vacancies, concessions. We're seeing rents trending down possibly in a lot of areas, regardless of vintage. The new inventory is pulling people up into higher quality assets, and then it needs to be backfilled in the lower quality assets. And there might be a gap. So in some markets, you might see higher Class C vacancies and higher Class B vacancies because everybody's moving up into the higher quality. There's concessions, and maybe it's closer to work. Maybe there wasn't a lot of inventory in that market at that point in time. You didn't, a professional didn't have the options as far as where they could go. They were kind of forced to be in that 1980s vintage property because that was all there was. And so now we're seeing this new inventory coming into market, and it's creating a proper opportunity for people to move up. And it's just, we're just seeing record delivery. So the lag to absorption, especially coming on the heels of, at least high inflation and, kind of a weak economy, has made it so these things aren't absorbing as quickly as you might like. It's certainly not keeping pace with the new inventory, but that's all short term. I think long term, first off, we haven't solved the housing crisis, and I'm not sure how that will happen, but it does create long-term fundamentals that are very, very strong for multifamily. And with new deliveries basically, or at least new construction basically grinding to a halt probably in 2022 after rates start spiking, we're going to see a rebalancing to where absorption is going to catch up and exceed deliveries and enable us to get to, I think, a really good landlord's market as it relates to rental growth and occupancies.
That makes sense. When you invest, are you predominantly investing in pref positions or debt positions, with your kind of background there?
Yeah, I've shifted completely from debt into equity, doing preferred equity. So we're looking at this as a partner with the sponsors in the deal. We are our position as a preferred equity provider is memorialized within the operating agreement of these sponsors as well. And so we are really just another equity player. We're not common equity, we are preferred equity. So it does create a situation where LP equity might not be as happy as being subordinate to us in terms of the cash flow of the property and the distributions. But the benefit is that we are not participating. And you asked that earlier. So we are not participating. So if you've got significant upside, you're getting all that upside on your own. It's very accretive to a promote structure on a typical investment.
Yeah, and I just want to make this clear for the listeners, just a little bit of Pref 101 here. So Scott, this, of course. So this is redundant for you, but basically, let's say if you're going to hit a 20 IRR as a deal, right? Well, if you hit a 20, the pref has a fixed return of that 16, and then the investors and the GPs have a spread above that number compounding, right? Or 14, whatever it may be. So that really can juice up your returns. It's not just, really on your end, that 4% delta you collect, it's much larger than that. But you also, let's say if the deal's a 12, well, guess what? You're probably in the prep position soaking up all of the equity and the juice in that deal. So from your perspective, it's kind of the perfect hybrid of an equity and a debt position and a vehicle to kind of sit right in the middle. Is that kind of how you analyze it as well?
Yeah, I think that's a great way to put it. We offer the upside benefit, but we don't participate in the downside risk. And so um,
Or
that's
not
why
as much per
people,
se.
yeah. So yeah, exactly. I mean, if there is downside risk that we're impaired by, then yeah, that's not good. We try to manage that in our underwriting and approach.
Yeah.
But yeah, to me, uh, the common equity, especially after what we've just gone through over the last, since 2022, is a little shy on something like that might make it so they're not seeing the cash flow. If they were investing in value add deals over the last 5 years or so, they might have not seen many uh, days or months of cash flow, thinking that they're going to do the value add and then reap the rewards later on, and then have that plan dashed by the spike in interest rates and then the expansion of cap rates on top of that.
Right. Yeah, and I think it's just very interesting your perspective on the matter of which, and just overall investing, just taking a step back for those who are a little less in the weeds when they look at deals. It's funny, you're a lender, right? So being a lender hardwires you to only see the downside in deals because your upside, of course, is fixed. It's the interest rate, right? It's the origination, this, that. But if you're investing in debt, the upside is irrelevant to you. You just really have to mitigate your downside. You obviously need to make sure that you think the deal is going to pencil and fundamentally speaking, it's sound, but you're not going to collect anything if it's a 30 IRR other than just your fixed rate of return. And I think so many times investors only look at the upside, but if they put their skeptical eye on, you'd really run into something which is the premise of risk adjusted returns, which is something that the more sophisticated you get, the more you look into it. And it's very interesting. I've seen a big shift of late with a lot of sophisticated people I know, a lot of people who are looking around at deals and are not seeing the risk premium make them feel comfortable because they don't really know what the bottom is. They're maybe not trying to time the bottom. They don't really want to put their bets out yet. So they're very comfortable with getting in, debt, hard money positions, pref positions, so on and so forth, because they think that that makes most sense for the risk they're accruing. So there's definitely a shift, but I almost can guarantee that in a year's time from now or 2 years' time from now, that those individuals who are more looking for that fixed rate or their downside protection are going to be a little more optimistic once absorption does hit. We are, through the worst of the bottom, that they feel a lot more cherry and rosy with their upside scenario on their, placements and their bets and investments, if you will.
No, I think that's exactly right. When rates were zero and there wasn't all this new inventory, it was a lot of the risk premium just was ignored. So you pay the same cap rate for a class B or B minus, even C asset as you would for an A asset almost. It just was really hard to make sense of. And then you weren't looking at the risks involved in the value add strategy. It's not an automatic. And so
No.
uh, we are still, I think, going through that adjustment period before we really see that. I think right now we're going through that discovery period, but there's still really not the distinguishing element between something that's say 50 years old and something that's 15 years old, like there was pre-zero interest rates.
It's very interesting you mentioned this, and we actually legitimately this morning on our morning call, Lone Star Daily, it's called LSD. I know what you're thinking. It's not what you're thinking. So on LSD today, we were discussing that, oh yes, well, Class A, the bottom hit before, but for Class C, and other assets like that, we're still discovering that, which I do think is an interesting premise, which speaks to, some markets and different dynamics. So that's just kind of an interesting caveat that you're talking about here. And I just think it's always interesting. It's funny. If you talk to someone, if you're an investor here, if you talk to more and more people in the space, you really should also speak to lenders and debt people, because sometimes you speak to people like me or just other investors and they're too optimistic on the horizon there. You got to think about the downside. So, and it's just kind of interesting. It's a very interesting case study that, you should probably have been debt investing in 2021 and 2022, or been in a more safe environment because of the risk premium from, buying at the market high with most exceptions. And then now I would be a lot more bullish on the optimistic upside of hitting a pretty good return or a crazy good return, just because, of course, the market is resetting in real time.
Yeah, so I agree. If you're able to buy at today's rate, today's cap rates, and lock in long-term financing that works today, the upside is growth is going to be tremendous. It's really hard to say how quickly things are going to turn, but they are going to turn, and I do think we are very near at the bottom.
Yeah, I would agree. I actually spoke with a very amazing former managing director at a very high level firm who's figuring out what his next chapter of his life will look like from an employment perspective and, interest perspective, really at this point with how well he's done. And very interesting conversation, but he said now really is the bottom, and he said make your bets now. So I've been kind of doing that all year. That's kind of what I've been sensing from, my indication and the conversations I'm having with the intelligent people like yourself and other individuals as well. But I think now is the time. And speaking of the time, I think you've been through enough cycles and you've learned a very important word, arguably the most important thing in life, but also most importantly in investing, which is discipline. So you got to be disciplined to make money and consistently make money through the cycles. So are there any lessons of discipline that you've learned along the way from the lending side, from this new kind of venture with, the prep positions and whatnot that you've learned that have helped you make money, or you see maybe people from afar kind of make mistakes due to lack thereof discipline, or maybe make a lot of money because of it?
Well, yeah, I mean, certainly I think there's probably a lot of case studies in discipline just over what we've seen unfold with the rate spike. But let me go back one thing that I think is really important now, and that is expense inflation. That
Your
is
expense
something.
ratios are brutal right now. Yeah.
Yeah, yeah. So I think that's probably the wild card that it's starting to raise its head with a lot of people realizing, okay, utility expenses going up, insurance. I mean, it's just across the board. And if you've got a RUB system in place and those utilities are going up and those are being passed through to the tenants, the housing cost for them is going up, much faster than your rents are growing. And so, that's a whole new dynamic that I think really needs to be part of anybody's underwriting. Now, going back to your original question, yeah, I think that the uh, the idea would be discipline should be something that's based on fundamentals and not based on how things are trading. There's a lot of people that got impatient, and it really just it helps create a bubble environment when people just think that the sky's the limit, and it doesn't matter what we pay because we're going to make a lot of money on this deal. We're going to add these improvements, and we're going to raise the rents, and
We're going to cut these expenses and
it's
it's
no
fine and
lose.
dandy. Yeah.
Exactly. So I think you've got to really measure all those factors, expenses as much as income, and be disciplined in your approach. It didn't matter when money was free, cap rates, risks were just ignored. And I think we're going to see discipline instilled now, and it's going to stick around for a while. But once people have been drinking out of that punch bowl long enough, it all goes to the wayside. If you want to play, you got to step it up. But we got to a point to where some of these buyers were just creating their own comps and basically building their own bubble. They'd overpay for something, but that was the comp for the next purchase in the same market, and it really created a a great opportunity for people to sell at prices that they never thought they would achieve on old properties. But it set up the buyers for some real pain later on.
Most definitely. Well, you've been really great, Scott. Thank you so much for your generous time and connecting with me today. Where can people find you, reach out to you, and learn more about you, maybe working with you, or maybe pick your brain on insights if you're comfortable with that?
I'm completely comfortable. I really appreciate the opportunity to speak with you and your audience here. So I'm Scott Croul, Croul at PeakHill Capital. My email address is Scott Croul, one word, at peakhillcapital.com. So pretty intuitive there. Feel free to reach out with me and be happy to talk about what we're doing, what we're seeing, and just life in general.
Amazing. Well, Scott, thank you so much for your time. We hope to have you back again. And for all the listeners who tuned in today, thank you so much. And we'll see you next week.
All right. Thank you, Craig.